What's up YouTube? Welcome back to Brokeman Finance. I'm your co-host Andrew, and today's video is about the cruise line stocks. Basically, we're going to look at each company and determine which company is going to end up on top or as the number one company at the end of the selling season. But as always, before we get started, please hit that like button and or hit that subscribe button. It lets us know that the channel is putting out good content and that way you don't miss out on our future videos. So for today's video, there's three main companies we're going to talk about: Norwegian, Carnival, and Royal Caribbean. Now 2020 was supposed to be the year, according to the experts and all the analysis of the cruise lines. Everything was going as planned, full steam ahead, and then they hit an iceberg. Now unlike Titanic, the cruise lines didn't foresee this iceberg appearing. They didn't know it was coming, and that's called, the iceberg is COVID-19. It just decimated the cruise lines, and it has the potential right now of sinking a couple of these companies. To give you a little perspective of how bad the coronavirus has impacted the cruise lines, if you're not aware, if you're not keeping up with these stocks, Carnival is down roughly 66% for the year. Royal Caribbean is down roughly 57% for the year, and Norwegian is approaching 70% for the year. Here's the main factor of what's causing this drop in price. No sale equals no sales. The CDC back in March 14th issued a no sale order for the cruise lines that was extended through July 25th. The Cruise Lines International Association, in addition to that, said, hey, we're going to step up and we're going to suspend all of our cruising until September 15th. Now, all that was a good plan, but if you're paying attention to the news, the economy started reopening. States like Florida, Georgia, South Carolina has seen a huge increase in COVID testing or the numbers. So I think this is only get extended a little more. I don't foresee them going back to full selling on September 16th. I think it could be extended another 30 to 45 days, which is going to impact the industry and the revenue, which we'll talk about here in a little bit. To kind of give you a perspective of how bad it's impacting, Carnival has reported that they're burning $650 million a month to keep their company going. They're not bringing in any revenue. I mean, if you look at the numbers and how the cruise lines break down the revenue, cruise lines bookings account for 72% of all the revenue, leaving 28% to be casino profits, cruise upgrades, on-ship purchases, alcohol, and etc. So as mentioned before, no sale equals no sales. If they're not having customers on their ships going to these different destinations for vacation, it's going to just decimate their company. They're not able to bring in any more revenue, and they're burning through the cash that they have for savings. The good news is every one of these companies have stepped up and said, hey, we have enough cash reserves on hand to get us really into the start of 2021. Anything after that, we're uncertain. We don't know. They probably have to get more loans. It's not a good outlook if they do not start selling sometime in the calendar year of 2020, preferably after September 16th. So for this video, I'm just going to really compare Carnival to Royal Caribbean. And the reason is they both pay out dividends, whereas Norwegian doesn't pay out dividends at all. So it's kind of hard to evaluate these companies. I'm a big dividend guy. I typically don't invest in a lot of companies that do not produce a dividend, just because it helps me reinvest that dividend and I'm able to grow my stake in that company. So before all this happened, Royal Caribbean paid out roughly 6% dividend yield, which equated, if you own one share of Royal Caribbean stock, you would get roughly $3.12 at the end of the year for owning that one stock based on the 4 quarters of the dividend payout. Compare that to Carnival, which had over a 12.5% dividend yield, you would get a $2 per share annual payout for owning that stock. Which, if you look at dividend yields, it was a better deal because Carnival also had a higher payout, the lower price. The stock price was around $30, $40, $50, how it fluctuated, compared to Caribbean, which was approaching up into hundreds of dollars, is a better buy for you if you're approaching as a dividend investor. So here's a snapshot. This is not an in-depth breakdown of the companies. Royal Caribbean is a smaller company, however they have more ports. They have more ports all over the world compared to Carnival, which most of their ports are in the United States and the Caribbean. Royal Caribbean has always been known for having a better quality ship, a better quality customer service, and just a more nicer experience as you go on vacation. But with the downside of that is you're going to pay a bigger premium for that nicer vacation. In contrast to Carnival, Carnival has always been known for cheaper ships. I've been on a couple of Carnival ships, and they do have some upgrades that need to happen. They have been very good about upgrading the ships over the past couple of years to compete with like Celebrity and Royal Caribbean, Norwegian. But you also pay a lot less money for that trip. I mean, you could go out to Charleston for like a 3 to 5 day vacation, pay a couple $100, and you have an all-inclusive trip. It's a very cheap, reasonable vacation if you're into sailing. The good news for either company is cruisers are a very dedicated group of customers, meaning that a lot of customers that go on cruise ships go on multiple cruises a year, or they go on a cruise every year. That's very, as I mentioned before, it's a very cheap and inexpensive trip for all-inclusive compared to going to a Sandals or a beaches resort where you're going to pay upward of thousands of dollars to get that experience. Now also you're stuck on a ship in the middle of the ocean, but it's a very inexpensive trip. If you have kids, they're able to enjoy things, a lot of different amenities on the boat or on the ship that attracts customers to them every year. So when you're looking at the companies, obviously Carnival is a much larger company. They have more employees, they bring in more revenue, they don't have as much debt as compared to Royal Caribbean. Royal Caribbean is a smaller company compared to Carnival, less employees and less revenue. If you look at the debt, we're not going to go into the financials of each company for this video. As I mentioned before, if you're looking at a good quality vacation compared to a economic vacation, you don't get what you pay for. Royal Caribbean has a higher premium, but they have a little nicer facilities, amenities, quality of food, etc. compared to Carnival. So when we're comparing the companies, here's one of the things I do not like about Royal Caribbean is their dividend payout ratio. Their dividend payout ratio right now is at an astonishing 353%. As an investor, that scares me. I'm not going to touch this company if I'm approaching it as a dividend investing option, is because it's just too high. I prefer anything under $100, obviously, or excuse me, 100%. I actually prefer stocks around 50% payout ratio or less. Think of it this way: you have $100 and you have to pay out money, or you're bringing in $100 of income and you're paying out $300. It's just not feasible. It's not sustainable. And what that tells me is at one point the dividends are going to get cut. They're going to get suspended for X amount of quarters, or they're bringing in or borrowing so much money to appease the shareholders. It's just not a good strategy if you're looking at buying into Royal Caribbean as a dividend investor. Now compare that to Carnival, which their dividend ratio payout is right at 73% right now. Now again, compared to the 353% of Royal Caribbean to the 73% of Carnival, all this is going to be adjusted when it's the next quarter coming in, and depending if they go sell or not. These two companies have a lot of restructuring to do on their books because simply they're burning through so much cash reserves and not bringing in revenue. A lot of stuff is going to be adjusted. So what that tells me as a dividend investor, I'm staying away from these companies. I just don't see them paying out the dividends because they just won't have the revenue coming in to sustain the dividend payouts. So if you watched any of my videos in the past, I'm huge on dividends because me, as someone who's not a multimillionaire or a millionaire at all, being able to take those dividends and reinvest into a company is able to allow me to grow my portfolio in a passive way where I'm not risking a lot of money. Here's where I do like these stocks for a small fraction of this. And that is, if you're buying in, obviously we're seeing these stocks are down 60, upper 70% for all three companies. So if you're able to buy in at a relatively low price and you're willing to risk the dip a little more, so right now Carnival is roughly at $15 a share. If you buy in at $15 a share and you're willing to risk it going down to $10 a share or $8 a share again, I think in the long term, and now on long term, I'm saying 3 to 5 years on the stock, because next year they have a lot of evaluation to do. They got to bring in a lot of revenue and they got to restructure and get these companies back on track where they're profitable. So for me, I'm viewing this as a long-term strategy. I personally am not buying any of these stocks right now because I think just because they're not bringing any cash, they're not bringing any revenue in to rebuild those reserves, you got to think of it this way. I think after third quarter earnings, obviously they're not going to bring any earnings in. I think right at $15 a share right now, it's going to dip a little more. The prices are a little inflated right now, but because Royal Caribbean and Carnival have announced some loans, and I think Royal Caribbean the other day had a $2.2 billion loan that they secured. And so the stock prices rose a little bit. Again, it's inflated. I think after the third quarter earnings release, you're going to see another dip in these stocks. And that's when I'm looking to buy in, because I do think we're probably going to go selling in sometime this fall. And I'm willing to let those $15 a share Carnival stocks drop to $11, $12, buy in some more. 3 to 5 years, again, you're not going to make a lot of money on this immediately, but I think 3 to 5 years, if you buy in, say at $15 a share even, it goes to $20, $25 a share, you're still going to make money. And for most people, $15 a share stock price is a pretty reasonable buy compared to, you know, someone like me. I can't buy multiple shares of Amazon. So that's my overview of the stocks. Again, I'm not buying any of these stocks right now. I will stay away from it for a dividend side, and right now for a long-term investor side until it drops a little more. Let me know what you think. Let me know if you bought in these stocks early on when the coronavirus first hit and it dropped to roughly $10 a share. I'd love to hear your thoughts and comments. And as always, thanks for watching the video, and we'll look forward to seeing you on the next one.